Hello everybody, I'd like to welcome you on our fifth educational webinar. The webinar name is Risk Management and Trading Psychology. But before we start the webinar, let me ask you to confirm that you can hear me properly and you can basically see my screen. So in order to confirm, please type yes, Y or plus sign in the question section, which you see on your screen. And basically, if you can see my screen with the webinar name and you can hear my voice properly. All right, I received enough confirmations from you, so we are ready to start. Once again, I'd like to welcome you on the webinar, and the webinar name is Risk Management and Trading Psychology. I'm Yuri Soprano, an A2Zmarkets.com Chief Currency Strategist and the person behind the daily free Forex signals on A2Zmarkets.com. I have a PhD degree in finance, and I work as an independent equity manager. I have extensive experience in trading stocks, crypto, and Forex since 2009. First of all, I'd like to tell you that the webinar is sponsored by Forex4you, and let me briefly introduce you to the company. eGlobal offers two main services: online trading on more than 150 instruments under the brand name of Forex4you, and copy trading investment services under the brand name Share4you. Before we start the webinar, let me briefly mention the disclaimer. Any opinions made may be personal to the author and may not reflect the opinions of Forex4you. All expressions or opinions are subject to change without notice. This material is considered marketing communication and does not contain nor should not be construed as containing investment advice or an investment recommendation or an offer or solicitation for any transactions in financial instruments. Forex4you makes no representation and assumes no liability as to the accuracy or completeness of the information provided, nor any loss arising from any investment based on a recommendation, forecast, or other information supplied by an employee of Forex4you, a third party, or otherwise. So far, so good. It's time to start the educational part of the webinar. There is an old saying in business: fail to plan and you plan to fail. It may sound glib, but those who are serious about being successful, including traders, should follow those 8 words as if they were written in stone. Ask any trader who makes money on a consistent basis, and they would tell you, you have 2 choices. You can either methodically follow the written plan or fail. If you have a written trading plan, congratulations. While it's still no absolute guarantee of success, you have eliminated one major roadblock. If your plan uses flow technique or lacks preparation, your success won't come immediately, but at least you are in a position to chart and modify your course. By documenting the process, you learn what works and how to avoid repeating costly mistakes. Whether or not you have a plan now, there are some ideas to help with your process. Trading is a business, so you have to treat it as such if you want to be successful. Reading some books, buying a charting program, opening a brokerage account, and starting to trade is not a business plan. Once a trader knows where the market has the potential to pause or reverse, they must determine which one it will be and act accordingly. A plan should be written in stone while you're trading, but subject to re-evaluation once the market has closed. It changes with market conditions and adjusts as a trader's skill level improves. Each trader should write their own plan, taking into account personal trading styles and goals. Using someone else's plan does not reflect your trading characteristics. So, how to create a trading plan? What are the conditions of a good trading plan? There are 10 essentials that every plan should include. So the first one is skill assessment. Are you ready to trade? Have you tested your system by paper trading it, and do you have confidence that it works? Can you follow your signals without hesitation? Trading in markets is a battle of give and take. The real pros are prepared and they have their profits from the rest of the crowd who, lacking plan, give you money away through costly mistakes. So mental preparation. How do you feel? Do you feel a good night's sleep? Do you feel up and for the challenges ahead? If you are not emotionally and physiologically ready to do battle in the market, it's better to take a day off. Otherwise, you risk losing your shit. There is guaranteed to happen if you are angry, preoccupied, or otherwise distracted from the task or at hand. Many traders have a market mantra they repeat before the day begins and get them ready. Create one that puts you in the trading zone. Additionally, your trading idea should be free of distractions. Remember, this is a business and distractions can be costly. The third one is set risk level. So how much of your portfolio should you risk on any single trade? This will depend on your trading style and your risk tolerance. It can range anywhere from around 1% to as much as 5% of your portfolio on the given trading day, though it is considered that 2% is kind of a maximum. That means if you lose that amount at any point of the day, you get out and stay out. It's better to keep powder dry to fight another day if things aren't going your way. So the fourth one is to calculate profit targets and risk-reward ratios. Before you enter a trade, set realistic profit targets and risk-reward ratio. What is the minimum risk-reward you will accept? Many traders will not take a trade unless the potential profit is at least 3 times greater than the risk. For example, if your stop loss is $1, your goal should be minimum 3. Set weekly, monthly, and annual profit goals in dollars as a percentage of your portfolio and reassess them regularly. The fifth one is do research. Before the market opens, check what is going on around the world. Our overseas markets are up and down. Our indexes, futures such as S&P 500 or Nasdaq exchange traded funds up or down in the pre-market. Index futures are a good way of gauging market mood before the market opens. What economic or earnings data is due out and when? Post a list on the wall in front of you to decide whether you want to trade ahead of an important report. For most traders, especially technical traders, it's better to wait until the report is released and then take in an unnecessary risk. Pros trade based on probabilities. They don't gamble. The sixth one is called preparation. Whether trading system and program you use, label major and minor support and resistance levels, set alerts for entry and exit signals, and make sure all signals can be easily seen or detected with a clear visual and auditory signal. So the seventh one is called set exit rules. Most traders make the mistake of concentrating 90% or more of their efforts in looking for buy signals, but pay very little attention to when and where to exit. Many traders cannot sell if they're down because they don't want to lose a lot. Get over it and you will not make it as a trader. If your stop gets hit, it means you were wrong. Don't take it personally. Professional traders lose more trades than they win, but by managing money and limiting losses, they still end up making profits. Before you enter a trade, you should know where your exits are. There are at least 2 for every trade. First, what is your stop loss if the trade goes against you? It must be written down. Mental stops don't count. Second, each trade should have a profit target. Once you get there, sell a portion of your position and you can move your stop loss on the rest of your position to break even if you wish. As discussed above, never risk more than a set percentage of your portfolio on any trade. The eighth one is called set entry rules. This comes after the tips for exit rules for a reason. Exits are far more important than entries. A typical entry rule could be worded like this. If signal A fires and there is a minimum target at least 3 times as great as my stop loss and we are at support, then buy X lots of currency here. Your system should be complicated enough to be effective, but simple enough to facilitate decision making. If you have 20 conditions that must be met and many subjective, you will find it difficult, if not impossible, to actually make trades. Computers often make better traders than people, which is why that explains why more than 50% of trades on New York Stock Exchange are computer program generated. Computers don't have to think or feel good to make a trade. If conditions are met, they enter. When the trade goes the wrong way or hits the profit target, they exit. They don't get angry at the market or feel invincible after making a good trade. Each decision is based on probabilities. The ninth rule is called keep records. All good traders are also good in keeping records. If they win a trade, they want to know exactly why and how. More importantly, they want to know the same when they lose, so they don't repeat unnecessary mistakes. Write down details such as targets, the entry and exit of each trade, the time, support and resistance levels, daily opening range, market open and close for the day, and record comments about why you made the trade and lessons learned. Also, you should save your trading records so that you can go back and analyze the profit or loss for a particular system. Drawdowns, which are amounts lost per trade using a trading system. Average time per trade, which is necessary to calculate trade efficiency, and other important factors. And also compare them to a buy and hold strategy. Remember, this is a business and you are the accountant in this case. The 10th rule is called analyze your trading journal. After each trading day, adding up the profits and loss is secondary to knowing the why and how. Write down your conclusions in your trading journal so you can reference them later. Successful paper trading does not guarantee you will have success when you begin trading. Real money and emotions come into play. But successful paper trading does give the trader confidence the system they are going to use actually works. Deciding on a system is less important than gaining enough skill to make traders without second guessing or doubting the decision. There is no way to guarantee a trade will make money. The trader's chances are based on their skill and system of winning and losing. There is no such thing as winning without losing. Professional traders know before they enter a trade that the odds are in their favor or they wouldn't be there. They're letting their profits ride and cutting losses short. A trader may lose some battles, but they will win the war. Most traders and investors do the opposite, which is why they never make money. Traders who win consistently treat trading as a business. While it's not a guarantee that you will make money, having a plan is crucial if you want to consistently, successfully survive in the trading game. So how to understand and calculate your risk? Sadly, retail investors might end up losing a lot of money when they try to invest their own money. There are many reasons for this, but one of those comes from the inability of individual investors to manage risk. Risk reward is a common term in financial vocabulary, but what does it mean? Simply put, investing money into the markets has a high degree of risk. you should be compensated if you are going to take that risk. If somebody you marginally trust asks for a $50 loan and offers you to pay 60 in 2 weeks, it might not be worth the risk. But what if they offered to pay you 100? The risk of losing $50 for the chance of making 100 might be appealing. This is 2-to-1 risk reward, which is a ratio where a lot of professional investors start to get interested because it allows investors to double their money. Similarly, if the person offered you $150, then the ratio goes to 3-to-1. Now, let's look at this in terms of Forex market. Assuming that you did your research and found a currency pair like this, you notice this ABC currency is trading at 1.15, down from a recent high of 1.20. You believe that if you buy now, in the not so distant future, ABC currency will go back to 1.20 and you can cash in. You have $1,000 to put towards this investment, so you buy 0.1 lot of ABC. You did all your research, but do you know your risk-reward ratio? If you're like most individual investors, you probably don't. So how to understand and calculate your risk? Before we learn if our ABC trade is good idea from a risk perspective, what else should we know about the risk-reward ratio? First, although a little bit of behavioral economics finds its way into most investment decisions, risk-reward is completely objective. It's a calculation and the numbers don't lie. Second, each individual has her or his own tolerance for risk. You may love bungee jumping, but somebody else might have a panic attack just thinking about it. Next, risk reward gives you no indication of probability. Or what if you took your $1,000 and played the lottery? Risking $1,000 to gain millions is much better investment than investing in Forex market or stocks market from a risk reward perspective, but a much worse choice in terms of probability. So how do we calculate the risk reward ratio? The calculation of risk reward is very easy. You simply divide the net profit, the reward, by the price of your maximum risk. Using the ABC example, if ABC went up to 1.20, you would make $50 in profit. You paid 1,000 for it, so you would divide 50 by 1,000, which would give you 0.05. That means that your risk reward for this idea is 0.05 to 1. Most professional investors won't give the idea the second look at such a low risk reward ratio. So this is a terrible idea, or so it. Unless you're an experienced trader, you would never let the 1,000 go all the way to zero. Your actual risk isn't entirely 1,000. Every good trader has a stop loss or a price on the downside that limits their risk. If you decide to buy at 1.15 to go up, maybe you set 1.05 as a maximum downside. Once your stop loss order reaches 1.05, you sell it and look for a next opportunity. Because we limited our downside, we can now change our numbers a bit. Your new profit stays the same at $50, but your risk is not now only $100. So we divide 50 to 100, which is 0.5 to 1. This is still not ideal. What if we raised our stop loss price to 1.125, risking only 25 in total? Remember, 50 divided to 25 is 2 to 1, which is acceptable. Some investors won't commit their money to any investment that isn't at least 4 to 1, but 2 to 1 is considered to be okay for Forex traders. Of course, you have to decide for yourself what the acceptable ratio is for you. Notice that to achieve the risk-reward profile of 2 to 1, we didn't change the top number. When you did your research and concluded that the maximum upside one was 1.20, that was based on technical analysis and fundamental research. If you were to change the top number in order to achieve the acceptable risk-reward ratio, you are now relying on a hope instead of good research. Every good investor knows that relying on hope is a losing proposition. Being more conservative with your risk is always better than being more aggressive with your reward. Risk reward is always calculated realistically yet conservatively. Okay, let me give you some risk reward tips. To incorporate risk reward calculations into your research, follow these tips. The first one is pick a currency pair using exhaustive research. The second one is set the upside and downside targets based on the currency price. The third one is calculate risk reward. And the fourth one is if you can't achieve the acceptable risk reward ratio, start over with a different investment idea. Once you start incorporating risk reward, you will quickly notice that it's difficult to find good investment or trade ideas. The pros comb through sometimes hundreds of charts each day looking for ideas that fit the risk reward profile. Don't shy away from this. The more meticulous you are, the better your chances of making money. Finally, remember that in course of holding trading instruments, the upside number is likely to change as you continue analyzing your information. If the risk reward becomes unfavorable, don't be afraid to exit the trade. Never find yourself in a situation where the risk reward ratio isn't in your favor. The next question is what leverage means. So the term leverage refers to the ability to trade or trade with a large amount of money without using your own money or using a small amount of it. That's it. It's done through a loan. Leverage offers users an opportunity to take risks in the market, increasing the amount of real money they have in their respective accounts in order to potentially increase any profit. For example, if a trader wants to use a leverage of 1 to 5, it means that every dollar that is exposed to risk actually manages $5 in the market. In this way, all those who wish to trade or invest use the leverage to maximize their profits in any particular investment. Okay. If the trades that are carried out within Forex, the leverage is the offer in general the highest that is available in the market. Likewise, the different leverage options are established by the broker and therefore can vary from 1 to 1, 1 to 5, 1 to 10, or even higher figures. Brokers are in charge of allowing traders to adjust higher or lower the level of leverage, but they will also set the limit. For example, the leverage of Forex4you offers has a maximum of 1 to 1,000. The leverage has downsides, and leverage is a multi-phased complex tool. The theory sounds great, and in reality, the use of leverage can be profitable, but the reverse is also true. Leverage magnifies both gains and losses. If a trader uses leverage to make an investment and the investment moves against the trader, his or her loss is much greater than it would have been if she had not used leverage in their investment. What is margin? The use of margin in Forex trading is quite common for many users, but at the same time, there is a greater confusion about the term. The margin is nothing else than a deposit made by a merchant and that fulfills the role of a guarantee that keeps a position open. Often the margin is confused with the fee of a merchant, but it's not. The margin does not represent the cost of the transaction. When a trader decides to trade with margin, he should remember that the amount of margin he will need to maintain an open position will depend on the size of the position of the number of open positions. The greater the number of positions, the greater the margin requires. Uh, in other words, the margin is an amount of money that is deposited in good faith to open position with your broker and ensure the same in case of losses. The broker uses the margin deposited to maintain your position. This basically deposits it together with the margins of all the users and then uses the entire amount to open the position in the currency market. The margin is usually expressed as a percentage of the total amount of the position. For example, most Forex brokers require a margin of 0.25, 1%, 2%, or even 5%. As was mentioned earlier, there is a lot of confusion regarding the concept of margin. However, there are different terms that include this word and that you should know to understand what each of them is about. Let me explain. The margin requirements is the most used and it is about the amount of money that your broker requests to open the position. It is reflected through percentages. On the other hand, the margin of your account is not more than the total amount you have. The used margin is an amount of money that your broker has used to keep your positions open. Although this money is still yours, you cannot use it until your positions are closed and your broker returns it or until a margin call occurs. The later it is an amount of money requested by the broker to be deposited in your account and keep your positions open. In the event that this required margin of your account falls below the limit of the losses you have suffered. Finally, there is usable margin, which refers to the money that's in your account and that you can use to open new positions in the market. So how to use leverage? In Forex, investors use leverage to profit from the fluctuations of exchange rates between two different countries. The leverage that is achievable in Forex market is one of the highest that investors can obtain. Leverage is activated through a loan that is provided to a trader by the broker that is handling the trader's Forex account. When a trader decides to trade in Forex market, he or she must first open a margin account with a Forex broker. Usually the amount of leverage provided is either 1 to 50, 1 to 100, or even 1 to 1000, depending on the broker and the size of the position that the investor is trading. Forex4you offers maximum of 1 to 1000. So what does it mean? A 1 to 50 leverage ratio means that the minimum margin requirement for a trader is 1 to 50, meaning 2%. A 1 to 1000 ratio means that the trader is required to have at least 1 to 1000 or 0.1% of the total value of trade available in cash in the trading account or so on. Standard trading is done at 100,000 units of currency. So for a trade of this size, leverage provided is usually 1 to 50 to 1 to 1000. To trade 100,000 of currency with a margin of 1%, an investor will only have to deposit $1,000 or euros or whatever currency you use into your margin account. The leverage provided to a trade like this is 1 to 100. Leverage of this size is significantly larger than 1 to 2 leverage, commonly provided on equities, and 1 to 15 leverage provided in the futures market. Although 1 to 100 leverage may seem extremely risky, the risk is significantly less when you consider the currency prices usually change by less than 1% during the day. If currencies fluctuated as much as equities, brokers would not be able to provide as much leverage. So how to use leverage? Imagine that you have $10,000 in your account to carry out operations. So trading with a leverage of 1 to 10 would give you a power of $100,000. The leverage you determined in proportions. Therefore, the leverage that you will have to achieve will be 1 to 10. If the position you opened reaches or $100,000, you would earn 100% of the profit, which would be 1,000. The leverage in this case allows you to conduct trades which are 10 times more than the capital required. The reason the leverage and Forex trading is so popular is that you do not require a lot of money to invest. A leverage of 1 to 1 is no longer attractive when Forex brokers offer a leverage up to 1 to 1,000. So while this example may not be realistic for active traders who typically seek small price movements, a leverage does not allow traders to make more money off smaller moves. While trading on margin and using leverage can increase your returns and allow your account to grow faster, it should always be used judiciously. The bottom line is trading on margin has inherent risks and may not be appropriate for everyone. You can mitigate some of those risks by using protective stop-loss orders and limiting your use of leverage by not using your entire margin balance. Just because you have leverage, it doesn't mean that you have to use it all in any given moment. In addition, you should adequately test any trading plan before putting in a live market and risking real money. So, what is the trading psychology? The trading psychology refers to the emotions and mental state that helps to dictate success or failure in trading securities. Trading psychology represents various aspects of an individual's character and behaviors that influence their trading actions. Trading psychology can be as important as other attributes such as knowledge, experience, and skill in determining trading success. Discipline and risk taking are two of the most critical aspects of trading psychology. Since a trader's implementation of these aspects is critical to the success of his or her trading plan, while fear and greed are the two most commonly known emotions associated with trading psychology, other emotions that drive trading behavior are hope and regret. So let's jump to the 4 psychological roadblocks that are stopping 95% of all the traders. So trading psychology can be associated with a few specific emotions and behaviors that are often catalysts for market trading. For an understanding of these qualities, consider some of the leading examples. So the first one is greed. Greed is an excessive desire of wealth. It often causes traders to stay in a profitable trade longer than it is advised in an effort to squeeze out extra profits from it, or to take a large speculative position. Greed is most apparent in the final phase of bull markets, when speculations run rampant and investors throw caution to the wind. There is an old saying on Wall Street that pigs get slaughtered. This refers to greedy investors hanging on to winning positions too long, trying to get every last tick. Greed can be devastating to returns because a trader always runs the risk of getting uh, wiped, saved, or blown out of a position. Greed is not easily to overcome. It's often based on instinct to try to do better, to try to get just a little more. A trader should learn to recognize this instinct and develop a trading plan based upon the rational business decisions, not emotional feelings or potentially harmful instincts. The next one comes fear. Fear causes traders to close out positions permanently or to um, refrain from taking on risk because of concerns about large losses. Fear is happening during the bear market, and it is a potential emotion that can cause traders and investors to act irrationally in their haste to exit the market. Fear often transforms into panic, which is generally causes significant sell-offs in the market from panic selling. When a trader gets bad news about a certain stock or a currency pair, it's not uncommon for the trader to get scared. Uh, they may overreact and feel compelled to liquidate their holdings or go to cash or to refrain from taking any risk. If they do that, they may avoid certain losses, but they also may miss out on goals. Traders need to understand that fear is a natural reaction to what they perceive as a threat, in this case, or their profit of money-making potential. Quantifying the fear might help, and traders should consider pondering what they are afraid of and why they're afraid of it. By pondering this issue ahead of time and knowing how they may instinctively react to the perceived certain things, a trader can hope to isolate and identify those feelings during the trading session and then try to focus on moving past the emotional response. Of course, this is not easy and may take practice, but it's necessary to the health of the investor's portfolio. So the next feeling is called regret. Regret may cause a trader to get into a trade after initially missing out on it because the stock moved too fast. This is a violation of trading discipline and often results in direct losses from security prices and that are falling from the peak high. So the discipline is, of course, very important as well because an undisciplined trader basically cannot make money on the market. You have to be disciplined to maintain your profit losses and to trade profitably. So the next slide is called Importance of Trading Rules and Plans. So to get their heads in the right place before they feel the emotional and psychological crunch, traders need to create trading rules. They should lay out guidelines based on their risk-reward tolerance for when they will enter a trade and exit it, whether through a profit target or stop loss to take emotions out of the equation. Additionally, a trader might say if certain news, such as specific positive or negative earnings or macroeconomic news comes out, then he or she will buy or sell a security. Traders would also be wise to consider setting limits on the amount they are willing to win or lose in a day. If the profit target is hit, they take the money and run. And if losing trades hit the predetermined limit, they fold up their tent and go home, preventing further losses. In addition, it's important that traders remain flexible and consider experimenting with new things from time to time. For example, they may consider using options to mitigate risk or setting stop losses at different places. One of the best ways a trader can learn is by experimenting within reason. This experience may also help reduce emotional influences. Finally, traders should periodically review and assess their performance. In addition to reviewing their returns and individual positions, traders should review how they are prepared for a trading session, how up to date they are on the market, and how they are progressing in terms of ongoing education, among other things. This periodic assessment can help traders correct mistakes, which may help enhance their overall returns. Trading psychology is often important for technical analysts relying on charting techniques to drive their trade decisions. Currency pair charting can provide a broad array of insights on its movement. While technical analysis in charting techniques can be helpful in spotting trends for buying and selling opportunities, it requires to understanding and intuition for market movements, which is derived from investors' trading psychology. There are numerous instances in technical charting where a trader must rely on only on the chart insights, but also their own knowledge of the currency pair they are following and their intuition for how broader factors are affecting the market as a whole. Traders with a keen attention on comprehensive currency pair influences, discipline, and confidence show a balanced trading psychology and typically contributes to profitable success. While it's important for a trader to be able to read a balance sheet or a chart, there is a psychological component to trading that should be overlooked. Being aware of how fear and greed can impact trading, how discipline affects your performance, and developing trading rules and plans are crucial to a trader's success. All right, so far so good. We are done with the educational part of the webinar, and I'd like to answer any of your questions. So if you have any questions, feel free to type those questions in the question section, and I'll be happy to answer it. The question is basically, do I follow a trading psychology rules myself? Yes, of course I do. As a professional trader, you cannot basically trade randomly, and you have to develop your own psychological and trading system rules, which would help you to be on the market. Of course, in the beginning, when I was starting trading Forex back in 2009, I was kind of impressed with the movies or TV shows where traders made a lot of money in a single day or a single trade. I was thinking that it's really easy to trade on the market. You simply follow the trend. It goes up, you open a trade, you wait until it reaches some level, and then you close it and you have a lot of money. So yes, I first in my career I lost several deposits, not even one, but several deposits, until I understood that basically you cannot avoid money management rules, the trading psychology rules, and overall you have to be disciplined if you want to survive on the market. So yes, I do. The answer is. So the next question is basically, is it a good idea to trade on the market if I'm tired or I want to sleep? I think I've already answered this question in my presentation. So the answer is obviously not, because you have to be concentrated. Like, trading is a business. If you want to be serious about this business, you have to seriously your attitude should be serious towards this business. So if you are tired and you want to go to sleep, go to sleep. Don't trade, because all of your decisions, they have to be 100% adequate. And in times when you're tired or want to sleep, you're not completely concentrated, and the quality of your decisions can be much lower than in times of your full capacity active stage. So in this case, if something happened with you, like with your relatives, with your family, you feel like you are worried, or you're tired, or any other, let's say you're out of your standard emotional range. So if you are, it's better to stay away from the market, because otherwise you can end up losing money instead of making money. Okay, one of you is asking me to return to the slide with the key just rules of creating a trading plan. There it is. Once again, it's skill assessment, mental preparation, set risk level, calculate profit targets and risk-reward ratio, research, trade preparation, set exit rules, entry rules, keep records, and analyze your trading journal. So if any of you want to take notes, please do. I'll be holding this slide for a minute. The next question is, why is it important to keep records? It is important because otherwise it's almost not possible to create a profitable trading system. When you keep records and you see that this trade was not profitable, you dig more into it and ask yourself, why isn't it profitable? Otherwise, when you have a statistics like a paper or Excel file, or in whatever form you want it to get, then you can see that, let's say you're using a fixed take profit of 50 pips, but only 30% of your trades were profitable. But if you change this take profit level from 50 to 40 pips, then the profitability of your trading system becomes not 30%, but let's say 50%. And in case of 30% profitability, it made you, let's say, $1,000 a month. And if you change the take profit level from 50 to 40 pips, and the profitability becomes 50%, it would bring you not 1,000, but let's say $1,200 per month. That would be much better for you to see the statistics of your trade and to calculate the optimum parameters of your trading strategy for it to maximize your profits. So keeping records is very, very important. I know that it's kind of boring, right? You want to trade, you want to enter a market, you want to follow the trend, buy and sell instantly, making money constantly, and so on. And keeping records, you don't have a time for it because it's boring. You don't see. It's better to spend time on the market buying, selling, making money than keeping records, right? Some of you think so, but I would say that every professional trader keeps his or her records. And even there are systems for professional traders which cost a lot, the programs which are keeping records for them and calculating those parameters. And myself, I bought such program and I pay on the monthly basis for such program to keep my records, to observe and to analyze my results and optimizing the parameters I use for my trading system. So if I'm as a professional trader with 10 years experience is paying for a program to keep my records, so you should keep your records as well. I'm not saying that go ahead and buy this program, no, but you can take a piece of paper and start writing it down, or create a text file on your desktop and then putting your trading records in there, or keep your records in any way you want, but please do that. The next question is, should I use all the leverage I have? Basically, the answer is obviously not. You should not use all the leverage you have, because let me just explain you on a very bright example. So if you, let's say, used a leverage of 1 to 1000, let's assume the maximum leverage you have, and you open a Euro USD pair buy order, and I would tell you that you'll be stopped out, you'll run out of your deposit when the pair moves 8 or 9 pips depending on the spread which you have against you. So if you've opened the Euro USD buy order, let's say on the rate of 1.1, and the pair went only 9 pips against you, you'll be stopped out. You won't have any money on your account. So this is very, very stupid from my point of view. You have to use leverage very wisely. If you're trading Forex, 1 to 5 leverage is okay. 1 to 10 leverage is okay as well, yes. But using even 1 to 100 leverage is a lot. And basically, as I said, from the money management perspective, you should not risk more than 2% of your deposit. So if you're using 1 to 100 leverage in a single trade, 2% of your deposit is basically 2 pips. So your stop loss has to be 2 pips if you're using 1 to 100 leverage. It's almost impossible to imagine such a tight stop loss on Forex. So probably if you want to maintain this 2% risk for a single transaction and you want to use your stop loss at least 20 pips instead of 2 pips, the leverage should be not more than 1 to 10. Okay. I guess it's clear. If you need, I can write it down on the PowerPoint presentation. But okay, I guess it's clear. One of you is saying that he is basically trying to maintain a minimum 1 to 5 risk reward ratio in all his trends, and in some book I'm not familiar with, he's saying that he read that if you're entering a trade with less than 1 to 5 risk reward ratio, you're gonna lose your money. I would disagree with this suggestion because basically a normal risk reward ratio is even 1 to 2 is an okay risk reward ratio, and the more the better. Yeah, I would not, I would agree with you that 1 to 5 is a very nice risk reward ratio, and it you're good to go with using it. But 1 to 2 is also sounds good to me. Let's say if you have let's imagine 50 pips stop loss and your take profit is 100 pips, so you're risking, let's say, $100 for the sake of $200. That's good enough, especially if you have a good level of prediction and the statistics say that the profitable trades occur more times than the loss trades. 1 to 2 is an okay. 1 to 3, 1 to 4 is an okay statistics or risk reward ratio as well. So I would not advise you to concentrate on minimum 1 to 5 risk reward. All right. Are there any other questions? One of you is asking about the downsides of leverage. As I said, that using leverage can be both, it magnifies both your profits and losses. So if you're trading on market and using high leverage, it can be beneficial for you if it goes in your direction, and it can be harmful for your deposit if it goes against you. So as it says on this website in the bottom, let me highlight it a bit. Leverage magnifies both gains and losses. So the more leverage you use, the more money you can gain from a potential trade, but the more money you can lose in this potential trade. So that is why you need to think twice before using a very high leverage. Okay, one of you is asking, one of the brokers is offering an unlimited leverage, and should I open an account with them? Either open or not open an account with them. It's purely your decision. I cannot advise you to do that with this particular broker. Then you don't share the name of this broker with me. No, I don't need to know it. But anyway, just imagine like 1 to 1 unlimited leverage. Why would you need an unlimited leverage? As I said, the maximum leverage of Forex4you is 1 to 1,000, and if you go all the way with 1,000 leverage and with your USD, let's assume your deposit will be stopped out when your loss reaches either 8 or 9 pips, which is nothing. It can happen in 1 minute. So why would you need an unlimited leverage for what? To make your deposit disappear the very second you push a buy sell button? Or I don't see any potential reason for anybody to use an unlimited leverage. Like, let's assume you decided to use 10,000 leverage. You open a trade and you'll be stopped out the very second you push a buy or sell button. Why would you need that? It just sounds ridiculous. So unlimited leverage is, from my point of view, is just a marketing tool to attract attention for traders. It doesn't have any like any value. because 1 to 100, 1 to 200, 1 to 500 is more than enough for an average trader to make money on the market. All right, what else? Do you have any other questions? If so, please type them in the question section. As you see, I'm answering every question I have. I think there are no more questions. So far, so good. Let me say thank you for attending the webinar. I'd like to remind you that we have a live analysis webinar on Monday, same time as today's webinar. And if you have time to join a live analysis market webinar, I would love to see you there. I would like to remember that we analyze pretty much every major currency pair that is traded on Forex, and also cross rates such as Euro, British pound, Euro, Japanese yen. We analyze gold as well. So if you are interested in those currency pairs, feel free to join on Monday, same time, for me, for a live market analysis webinar with exact entry points, stop losses, and take profit levels, and more educational information in the beginning. And so far, so good. I wish you a very nice weekend and a lot of success in your trading. Thank you very much for visiting, and bye bye.